Have you ever been in a trade where if the trade hits your stop loss, you end up losing your entire portfolio? This is because you don't understand risk management. So what I'm going to do in this video is a deep dive into risk management and teach you step by step what you need to do about risk management so that you don't end up blowing your account in one trade. Rather, it's going to help you to stay afloat and become profitable trading the financial market. If this is the kind of video you're interested in, then make sure to hit the subscribe button right now. We are trying to get to 100,000 subscribers by the end of the year. Do that right now to be part of our journey. Now let's get started. So let's say you have $100 in your portfolio. Now the mistake some of you do is when you want to enter a trade, you're going to enter with this $100, and when the trade hits your stop loss, you lose the entire $100, and possibly sometimes if it hits your take profit, maybe you make $50 or you make $100, right? Which is kind of like a 1-to-1 ratio. If you're losing this particular trade, you lose everything, and if you're winning it, you're winning extra $100, making your money $200. This is basically the wrong approach to trading, and that's why you've been losing money trading the financial market, be it stocks trading, futures trading, or forex trading. So what you can basically do is, first of all, identify how much you have in your portfolio. So let's assume you have $100 at the money in your portfolio. Now the next thing you want to do is to find out what is the best amount to enter a particular trade. Now some persons are going to recommend 1% of your portfolio to enter trades. That is like the general standard for any person entering a particular trade. Now 1% of your $100 is simply $1. If you enter a trade with $1 and you take, let's say, 10 trades in a row and you lose all of them, what you basically lost is 10 trades multiplied by $1, which is $10. So you still have $90 left. So you can see that you have to lose 100 trades in a row for you to lose your entire portfolio. Now, other persons are going to tell you that using 1% of your portfolio is very, very small. And I agree sometimes, especially for those with small capital. If you have $100,000 or $1 million and you're entering with 1%, like, it makes a lot of sense for you when you make profit from it. But when you have a very small portfolio, less than $1,000 or even $10,000, it doesn't really make a lot of sense to use 1%, right? So what you want to do is to phantom maybe a higher amount. You can use a higher percentage of a portfolio. Some persons do as high as 5%, some persons go as high as 10%, but I think 10% is not very, very good, especially if you're not a good trader. The basic thing to understand is, one, you need to be a very good trader for you to start applying the better risk management, because you could know how to do risk management, but if your trading is poor, you still end up blowing your capital. So first, you need to be a good trader. And then next, I recommend anything below 5% is actually fine, 5% of your portfolio. So if you're using 5% of $100, for instance, that's around $5 you're using to enter a trade. So if you hit your stop loss, you end up losing $5. And if you hit take profit, you possibly hit more than, let's say, $10 or there. But I'm going to talk about risk to reward just after this section I'm talking about right now. So, all right, so a good example of what risk to reward is if you look at this trade right here, you can see the risk to reward ratio is showing as 1, which simply tells you that anything I'm risking, if I enter this trade with, let's say I'm risking $100, if this trade hits my stop loss at this point, I'm going to lose $100. If this trade also hits my take profit, which it did hit, right, I'm going to make only $100, which increases my money by 100%. So this here is a terrible risk to reward. So imagine, for instance, your risk to reward ratio is 1 risk to reward 1, and then you've taken, let's say, 10 trades, and let's say your win rate is 40%, meaning you're losing 6 trades and then you're winning 4 trades, right? Now, if you do a 1-to-1 risk to reward ratio, it simply means 1 multiplied by 4 trades which you won. Let's say for each of the trades is $100. So $100 multiplied by 4 is going to give you $400, right? This is your profit. And for the 6 trades you've lost, so you're going to multiply $100 by 6 trades, which is going to give you loss of $600. So by the time you subtract your profit from your loss, you can simply see that you are on minus $200. So you can see that a 1 risk to reward 1 ratio is not very good if you're a trader. Now it could be good if, let's say, in 10 trades you're winning let's say 9 trades or this thing, but it's on most cases you rarely see people winning having 90% win ratio or even 80% or even 70%. Most times it's between 40, 50 to 60%, even with the best traders you actually know. So So if you're targeting a higher risk to reward ratio, let's say 1 risk to reward 3, what this simply means is for each trade, if you're risking $100 for each trade, you should be making $100 times 3, which is $300 for each trade. So let's say in 10 trades, you had that same 40% win ratio. Now, what simply means is for every time you lost a trade, you're losing $100. So $100 multiplied by 6 is going to give you $600. And for every time you won a trade, you're winning $300 multiplied by 4. That's going to give you $1,200. By the time you subtract that, you still have $600 as profit, right? Now compare this 1 risk to reward 3 as against 1 risk to reward 1. You can see that there is a lot of improvement, even with just even with the same win ratio. It's just that you're targeting more profit at this point. And if I even go further to increase your win ratio, you can see that with the 1 risk to reward 3, you're going to make a lot more money for yourself. And even if you lose, let's say 7 trades in a row, with just winning 2 to 3 trades, you've actually recovered back all your losses. That is why you need to focus on having a very good risk to reward ratio in any trade you actually take. So for this kind of trade on my PC right now, what I would recommend is you take possibly 1 risk to reward 3, which for me it's like the best for me. Some persons go as high as taking 1 risk to reward 5. Some persons do 1 risk to reward 2. Anyone you do, make sure you're very good. Make sure your win rate is also very good. It's going to help you to be profitable when you're taking trades. All right, so I have 2 more things I'm going to talk about in this video, which is the first one is how to calculate your position size, and the next one is for those that want to enter a trade and then it hits, let's say they're on profit, but it comes back again to hit their break even and they leave the trade. I'm going to talk about if it's a good thing to do or not. So let's start with how to exactly calculate the amount to enter a trade with your risk to reward ratio right here. So let's say we are going with the risk to reward 3, and then we have a capital of $1,000. Now, what I would recommend is using 5%. So if you're using 5% of $1,000, that should be $50 per trade, right? So for this kind of trades with 1 risk to reward 3, how do you calculate your leverage to know the exact leverage to enter this trade with? It's simple. What you're going to do is to divide 100 by 1.29, and this is going to tell you that your leverage is supposed to be 77x leverage. Let's say it's like you have a 2% stop loss. Now, what is the kind of right leverage to use on this kind of trade? It's simple. You just do 100 divided by 2, and then you're going to get a 50x leverage. That's what you're supposed to use to enter this trade. It's very, very easy. Like that's I don't even use calculator to do mine, but I mean, if you want to learn how to do that, that's possibly the best way you can actually do it. So let's say we enter this trade with $50. If it hits our stop loss with our 50x leverage, we are going to lose $50, right? But if it hits our take profit, it's going to be $50 multiplied by 3, which is $150. So for every time we risking $50, we are intending to make $150. It's very, very simple to calculate. So what you need to always do is look out for what is the percentage of your loss. And let me also do this in a reverse form so that it doesn't look like I'm only doing for one particular market. So let's say you were trying to long, right? Let's say you are trying to take a long position from this point here. So your entry point is here, and then you're targeting higher prices, right? Now, what you're concerned about is what is the percentage you're seeing right here? It is basically 1.52%. Let's try to increase this to 5%, for instance. How do you basically calculate the leverage you're going to use on this trade? It's simple. Just go ahead and do 100 divided by 5.034, and then it's going to give you a 19.8x leverage. So what I'm also going to recommend is you don't exactly use 19x leverage. The reason for that is there's funding fees whenever you enter a trade, and then all of that. So whenever you're optimizing for this, just assume that this is possibly, like, especially for people trading crypto, because I've gotten to understand this for futures traders a lot, that when you calculate this thing completely, it doesn't get to your stop loss before it exits you from the trade. So try to give some room for your stop loss. So instead of 5% here, you can do 100 divided by 6 or by 7, and then that should give you around 14x leverage. So that's possibly what you should be using. Although in the normal settings, you're supposed to use this exact amount, but calculating funding fees, especially when funding fees are high, it's better you have some little bit of adjustment from this percentage. You don't use this exact amount, just try to add up something a little bit to it, and then do the mathematics, and you should be able to get the amount you should use as your leverage. So if you use $50 to enter this trade, you're risking $50, and then you're making but with the 3x you're making $150, right? So I think that is very, very simple. So whenever you enter a trade with a certain amount, you know that you're risking all of that amount you're entering. You don't necessarily have to set stop loss again in that kind of trade, since you're risking 100% of the amount you have. But let's say you're using the entire $1,000 to enter a trade, right? But what you only want to risk is $50 inside this $1,000. Remember, you're entering the trade is $1,000, but if it hits your stop loss, you want to exit with $950 and only lose $50. What you can basically do is to use a crypto calculator. Although off my head, I can basically calculate this, but for someone that is actually new, you basically can use FX crypto calculator to basically do this. Now, how do you do this? Open up this calculator on your phone, and then click on crypto for those that are doing crypto. So let's say your capital is $1,000, right? And you only want to risk how many percent of your capital, which is 5%, right? So which is $50. So you put in your entry point. You put in your entry point for this particular trade here. So your entry is 0.6834. So you type 0.6834, and then your stop loss is going to be this one you're seeing right there, which is 0.6490. 0.6490. So it's going to give you a position size. So trade amount, I want to enter this trade with $1,000. So if you're entering with $1,000 for this trade amount, your leverage here is simply 1x leverage. You can see it right here. So you can also set your take profit. Let's say your take profit here is 0.7861. So if it hits your take profit, you're going to make $149, which is approximately $150. But if it hits your stop loss, you're going to lose $50, which is what you can see right here. So even if you were using, let's say, $500 as your trade amount, you would have used a 2x leverage, and you're going to still make the same thing. So depending on how you want to do it, if you still want to use your entire amount, your entire capital to enter the trade, just need to calculate what is the exact leverage to you, so that you're not over leveraging, and then it's ending up taking off all of the money you have, or most of the money you have. And if you also want to go with the first strategy, which is using the exact amount you want to enter the trade, it also works very well. If I'm using $50 my trade amount, you can see my leverage is now 19.9x leverage, which is also going to give me the same results. The only thing is it's adjusting based on your trade amount and your leverage. So I hope you should be able to calculate your leverage and know your position size going forward. Now let's go to the final part of this video, which is, should you take break even? So first of all, what is break even? Break even is simply, I'm going to use Jordan chart pattern. Break even is simply, you enter the trade right here, and this trade now, you can see it's already running on profit a little bit. So some persons will choose to change their stop loss from this point here, to using the entry point as their stop loss. So sometimes what happens is, maybe the coin continues going upward and then it hits their target, but sometimes it comes down and hits their entry point, and because they've moved their stop loss to their break even, it simply takes them out of the trade. So the question now is, should you use break even when trading? Yes or no? For me, it depends on the kind of trader you are. Maybe you're going to backtest and test your strategy over time and see which actually works. If you're able to find that out, then you will know if you're going to use break even or not. But if you really want to use break even, what I'm going to recommend is you don't randomly enter break even anyhow. So I'm going to use shorts. So when we are shorting from there, then we are targeting lower prices. So let's say our entry point was here and our stop loss was above here, and then you can see that this trade was riding on profit. So how do you know the exact time to enter break even? The exact time for me is when you look right here, we had a point where this market moved to this point. So I want to wait to see that we've actually broken below this area here. You can draw it from here. You can also draw it from this point here, which seems like to the width for the lowest point. So the moment we've broken below here and we are going lower, this simply tells me that based on market structure, we should be going lower. I should be able to move my stop loss to break even, right? Or even maybe at this point here. Or if I want to be a little bit conservative, I'm going to just keep it at break even. So if it comes down. Look at what it did there. It came down, went up a little bit, and created another break of structure, BOS. So this simply tells me that it is still in the downtrend. I can now move my break even to this point. So at this point, if this market comes back from here and then hits at this point here, it's going to take me out of the trade. I would possibly move out to the profit I've made from this point to this very point right here. So that is basically how you're going to do it. So for every break of structure you witness, look at it very well, make sure it's the right break of structure, then you can adjust your leverage as it keeps going down. So in a situation like this, let's see how would I possibly manage this trade if it was still going down. At this point here, you can see we've actually broken another structure, although not with the body closure, but it's still a signal to me that possibly there might be some downtrend. You are going to move your stop loss from this high here to this high here, and then let's see how it plays out. So you can see right here, the trade has basically hit our take profit, and let's say our take profit was even higher than this. Let's possibly see how I would have managed this trade. I'm going to drag this a little bit further. So let's say it hasn't hit our take profit yet. It's still going down. Let's see if it's going down or up. Remember that at this point when it has had this break of structure, which signals that there's more tendency that it's in a downtrend, I'll possibly start targeting some of either these highs there, which is like the highest point at this region where it went to, and let's see how this played out. So if I was targeting that, let me just draw this from these highs here. So the highs there was actually at this point, so I'm just going to take it down to this area. You can see we basically got stopped out, but look at the profits we have actually made from this very point here down to this very point here. So if you're using, let's say, a 20x leverage for this trade, you've made 3.93%, which is almost a 4% multiplied by 20, which is an 80% profit on this trade. So this way you've exited while staying on profit. But sometimes, although this strategy I'm talking about is a little bit steep, like I'm following it back to back, some persons will still leave their entry point at break even if they are targeting higher prices down here. So it depends. You can follow it conservatively, not like with a lot of pressure as it's going, you're putting no. Sometimes it might work, sometimes it might not work. Your market is obviously going to come back, take liquidity and continue downward. So you need to actually identify how you're going to do yours, not just a random amount. You just use an entire move your stop loss and all of that. So I hope this video was able to make you understand this concept properly. If you did, make sure to give this video a like and subscribe to this channel. We have a lot more videos in this series coming very soon. So if you want to learn how to trade, how to read the chart and everything, make sure you're following our channel. Subscribe right away if you don't want to miss that. And if you want to learn about liquidity inducement and how to calculate the right range, you can basically click on this video here or click here if you want to learn about market structure.